Hi everyone. Now that we have finished week three's content here at UCITS, starting week four's content really soon, I think it will be a good time to start going back to week one and week two and doing review videos. Since the content has now settled in a lot more, I could do review videos on the four subjects that I'm taking right now, including OLE, as well as the two OLEs that I'll be taking next semester. So it is 10:38 on a Saturday night. I'm in the UCIT campus law library. I don't mind taking you guys on a quick tour. I'll just quickly pop right out and pop right back in. So we have these Zoom rooms where we are allowed to talk inside. So I'm speaking through the AirPods, so the audio may not be the best. Anyways, if you're here for the ACCT 1006 content, then you are in the right place. So let me split to the screen. Let me downsize my camera really quickly. Since what you want to see right here is the notes, are the notes. All right, let's move to the screen. All right, so quickly, just an overview of ACCT 1006. So first of all, this the course's content is accounting and financial management, and it has a prerequisite. The prerequisite is Buzz 1030. I think accounting and business decision making, if I do remember correctly. I took Buzz 1030, as you remember from our previous review videos, and now we are taking ACCT 1006. I think a very good thing for a good tip for uni in general um, is to go through how you are being graded for this specific course. If you are being graded upon tutorial participation, reflective analysis, or activities, quizzes, exams, and whatnot. So a very good first step it would be to break down how you are graded. And so for ACCT 1006, 5% of our grade comes from tutorial participation. Attending all the tutorials is definitely very good and very important. In addition to just the tutorial participation grades. Let me find a better spot. I feel like this background isn't really good. Is that background better? Yeah, that background is more clean. I'll move to another table. So, so know how you are being graded. Know how you are being assessed in terms of where your grades will be coming from, and through that you will be able to better position yourselves to get better marks. All right. So tutorial participation. Tutorial work and tutorial participation, reflective analyses, quizzes, and semester exams and final exams. So before we really get into ACCT 1006, we have to really understand what the content is about. So, so here we can see the content for the course. We have a conceptual frameworks for accounting in week one. Week two, we'll talk about foundations of accounting. So this talks about the recorded process, really an introduction to debits and credits. Because in the previous course about accounting, Buzz 1030, we don't really talk about debits and credits. Buzz 1030 is really just an overview, understanding, a bird's eye view understanding of what accounting is. And ACCT 1006 is more for accountants. So, so I think a good way to think about it is the previous course Buzz 1030 is for users of accounting information. So this is for businesses that are using accounting information. However, ACCT 1006 is for preparers of accounting information. So that's a good separation between the two. Another thing to take a note of is so week three we talked about foundations of accounting, about accrual accounting. So the big differentiation is cost versus accrual based accounting, as well as journals and closing journals and how accrual based accounting will affect closing journals and whatnot. So what I'm doing right here is giving a bird's eye view, a snapshot of what the course is about. So as you can see from week four, we talk about more completions of the accounting cycle. So how does it go from the ledger to the general ledger to the finally goes to the financial statements. How is it recorded? So you can pause this screen and you can see the course breakdown. So it's really good to first understand how you are being graded, how you will be graded, and then understand the course breakdown and how the course is going to be structured. So our textbook is Financial Accounting Reporting, Analysis, and Decision Making. So this is the textbook that we'll be using, and I think a good first step will be to identify what accounting is as a subject, as a course, but also as give a working definition. I think previously in Buzz 1030 we did give a working definition, and it still really much holds true. Even as we have progressed along or seek to progress along in our knowledge of accounting. So accounting is the process of identifying, measuring, recording, and communicating the economic transactions of events of a business operation. So that sums up what accounting is. This is identifying, measuring, recording, and communicating the economic transactions and events of a business operation. So we could further break this down into identifying is taking into consideration all transactions which have affected the business's entity. So what transactions, what events, what purchases, what mergers, what are some transactions that have affected this entity, this business? A measuring will be quantifying, in monetary terms. We have a concept called the monetary concept of accounting, where it is the idea that transactions and purchases will be denoted within currency, will be denoted in terms of monetary terms that really allows us to become to compare transactions between one and another. So measuring, recording, analyzing, documenting, summarizing these transactions, making it into a universal, debits and credits readable form, and lastly, communicating. So these are preparing the reports, preparing the actual ledgers, preparing the information that you are used to go to creditors, go to lenders, go to shareholders, different stakeholders or shareholders, and communicate the financial information, financial position of the firm. Now, in terms of roles in accounting, there are different types of roles, ranging from commercial to public. So commercial would be you being within an organization, being within a government, or being within a company, for example, doing the books for the company. So that'll be commercial accounting. Public accounting will be you auditing these different firms. You perhaps working for a big four audit firm, KPMG, Deloitte, EY, Ernest Young, as well as what's the third one? KPMG, EY, Deloitte. Anyways, it's skipping me, but so yeah, as well as government accounting and not-for-profit accounting. So these are some different examples of roles in accounting. Now, more specifically in module 1, we talk about some conceptual frameworks, understanding some concepts and some very foundational ideas around accounting. So we talk about accounting. We talk about primary users. So primary users are stakeholders that have an economic interest in the company. So these could be creditors. Creditors are those that provide funding, those that provide loans, for example, to companies. These could be investors. Right, these investors invest capital, invest monetary money into a company for a stake for a percentage. They could be on public exchanges or they could be private investors. Lenders and creditors are quite similar. So these are primary users. These are users of accounting information that has economic interest in the firm. Now, in addition to primary users, there are other users. So these are stakeholders without an economic interest within the firm. So there are stakeholders, anyone affected by the organization is basically a stakeholder. That is the definition that we gave in previous courses, such as Buzzword 1000. Government organizations, the public. If some people work in communities that are centered around a big company, a big corporation, and it's very quite important for the livelihood of towns and the livelihoods of certain areas that a company goes on. So yeah, other users may be very interested in the firm. However, what differentiates them from primary users is that they do not have an economic interest within the operations of the firm. They may have other interests within the firm, such as the social good through the public or through the government, but they don't have an economic interest. I previously alluded to the monetary principle. So the monetary principle is basically the idea that transactions and events that happen to a company are measured according to the entity's financial statements and using dollars, using pounds, using yuan, using monetary units to denote these transactions. Okay, so if for example, I as a company have 10,000 water bottles and I want to exchange them for 50 phones or 5 phones or probably like 500 phones, but when such a transaction happens, I cannot denote such a transaction on my accounting statements with denoting as iPhones, right? I have to denote them in terms of monetary units, as Australian dollars, as European euros, for example. Okay, next we have the accounting entity concept. So this is the idea that each accounting entity is separate from its owner. So me as an individual have my own books, and they are separate from the books of a company that I may own, and they are also separate from the books of the trust that I may receive benefits from. Trust as in a trust fund that I may receive benefits from, and they are totally separate from perhaps the charity that I run, which also has a charitable trust attached to it. So this is the idea that each accounting unit or each accounting entity is separate from each other. I am separate from my company. We have different books. Our incomes are not the same. Okay, and then I am separate from a trust. A trust is another separate accounting entity. So this is the idea of accounting entity concepts. Yeah, accounting period. So accounting period. It's very important, especially when it comes to financial statements. Financial statements for income statements, they usually have for the period starting or the period ending, so from 1st of July to the month ending whenever. So these are very important because financial statements are prepared for a definite time period. A definite time period that has a stated date and a finishes balance date. So, if you remember from Buzz 1030, income statements and cash flow statements follows a period. However, balance sheets follows a specific time and date. So it's very important to also think about ideas of all the so yeah. Anyways, so all the transactions of the events between these dates are recognized in the company's financial statements. So yeah, going concern assumption. This is the assumption that the company or the organization will continue operating and will not just liquidate itself in the going future. Historical cost concept is the idea that all assets are initially recognized as their original cost. The amount does not change over time. So of course there are changes to this and adjustments such as depreciation or even appreciations of certain assets. However, the historical cost principle is the idea that how much you acquire a certain asset for will stay the same across time. Even though the market value may be different. This is in contrast to other recording principles such as fair value, so reported to fair value, or even reported to market value, which will be a whole different topic and a whole different course by itself. Full disclosure principle is the idea that within these financial statements, all events and transactions that impact the financial statements users' decisions have been included. So this is the idea that all the information that is relevant, that is needed, that is reasonably expected to be included within these financial statements will be reported upon. This is very important because it really increases the trust and increases the ability for users of financial information to trust that the management within a company is disclosing all relevant information that is needed for creditors, for lenders, for the public, for governments to make informed and calculated decisions based on the financial statements that is provided. Conceptual frameworks are frameworks and structures for many parts that fit together. So this isn't a set rule. This isn't a set accounting standard. However, it is the idea, it is the concept, it is the framework, right? The conceptual framework behind these rules, behind these accounting principles. So therefore, conceptual frameworks defines the natures, the purposes, the content, the general idea, and general purpose of financial reporting. All right, let me take a quick water break. So if you can't tell between semester 1 and 2, I changed my laptop now into now using a Mac instead of Windows. I'm still getting used to how to use a Mac, but a lot of it is quite similar. Just I need to relearn the shortcuts. Anyways, with that short water break, let's get right back into it. So the first objective of general purpose financial reporting is that information must be useful. Financial statements need to allow financial information users to make informed decisions about buying, selling, holding of equity and debt instruments. As well as so these are primary users. So primary users should have a reasonable belief that they are being informed of what's happening about the company, especially if they're owners of the company, such as in the case of being equity investors. Second objective of the general purpose financial reporting is stewardship. This is the idea that information about how efficiently and effectively the entity's management have discharged their responsibility. So yeah, so reporting entity is the entity that's required or chooses to prepare financial statements. An example would be publicly listed companies. Publicly listed companies are required under law to provide financial statements. If you are in the U.S., listed on the Nasdaq or NYSE, you're required to publish financial statements every quarter. So this it could be either a single entity or can comprise of more than one entity. A reporting entity is not necessarily a legal entity. All right, so that's a few caveats about reporting entities. General purpose financial statements are intended to meet the needs of users who are not in the position to require an entity to prepare reports tailored to the particular information needed. So once again, preparing financial statements is very complex. It's very expensive. In some cases, hire a team of accountants and some auditors and lawyers. So it gets very expensive. So general purpose financial statements is a way to combat that, or not to combat it, but to mitigate a lot of these complexities. Public accountability is the idea that an entity has public accountability, so accountability to the general public if it has debt or equity instruments that trade in the public markets. For example, as I gave previously, the example would be publicly listed companies are required by law to provide public accountability, to provide financial statements, whether it be disclosures such as 10Qs, 10Ks in the US. 10Qs or 10Ks would be the quarterly and the yearly financial statements. Fundamental qualitative characteristics, or these are attributes that make the information in financial reports useful. Often these are used to justify the accounting treatments of a transaction or event of the reporting entity. And enhancing qualitative characteristics builds upon similar ideas about foundational. However, it adds upon foundational qualitative characteristics of comparability, verifiability, and understandability, as well as timeliness. So these are characteristics of financial statements. They should be comparable, so comparable to previous years of financial statements, as well as broadly comparable to peers and other companies that use the same accounting framework. Verifiability is the ability, auditors to come in and verify the truthfulness and verify the validity of these financial claims. Understandability, it shouldn't be too hard for a well-informed, reasonably well-informed individual to understand the information provided. So, what is revenue doing? What is profit doing? And through that, we can see the profit margin. Through that, we can see the cash flow. Through the cash flow statement, how is the company investing in itself? So, understandability, it shouldn't be encryptively or deceptively descriptive or encryptive that people cannot understand. Lastly is timeliness. Once again, you're required by law to provide a financial cash flow statements every quarter. You should provide it every quarter and not half a year late, right? So, okay. Assets. So these are some definitions of very important accounting terms. What are assets? What are liabilities, equities, revenues, expenses, recognition? A lot of this comes from it's a direct continuation of what we have learned in Buzz 1030. So I won't be going into it. You can pause the video. You could see the video, right? You could pause the video and you could look more in depth into these. All right. So what are conceptual frameworks? When we previously talked about it, so conceptual frameworks are uh, right. These are really accounting standards, but they are ideas and guiding principles to how accounting frameworks are constructed. Um, okay, basically, these conceptual frameworks are universal. Ideas that the general purpose for companies is to report and whatnot. So we have qualitative characteristics. So now we go into a little bit more depth about enhancing qualitative characteristics of a company. So qualitative characteristics that talk about comparability, so allow users of financial information to be consistent. So you can't, uh, yeah. So and this may make a lot of sense when we get into more increasingly complex topics. For example, when we get into The IFRS versus the GAAP may have very different rules. I'm not really quite sure, but they may have different rules about depreciation and how depreciation could be recognized. And if you use IFRS one year and you use GAAP the other year, that it messes up the whole comparability dynamic. And you're like, so wait, does it depreciate to this point, and then it goes back to depreciation? So it's very important to have comparable financial reports, verifiability, understandability, and timeliness. Constraints of financial reporting. So there are financial reporting are not perfect. So once again, first of all, it's understanding that you have to have the understanding that financial reports are very expensive to make. If we go on Edgar, so Edgar is the electronic data gathering and analysis retrieving system for the U.S. SEC, the Securities and Exchange Commission. So for example, if I want to go look for Apple, all right, let's go back. Sorry. So Apple Incorporated, so AAPL. If I want to see the 10K, so the current quarter report filings, and then I can see this is their filings. Let's go see. Right, this is not what I want. 10K, 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 filing. All right, it should be this one. Why is it? NASDAQ. And you can see how these files um, are very long, very complex information about the company, and it's very expensive. So this is the 10Q. So that will be the quarterly filings for Apple's financial statements. Now, of course, Apple's the biggest company in the world, so of course you're going to have armies and armies of accountants, armies and armies of lawyers and auditors to make sure the financial liability, the financial information provided is meets the qualitative criteria, that it is comparable, that is valid, that is understandable, that it is timely. However, if you are a smaller publicly listed company, and you are required by SEC law, you're required by law, at risk of delisting, at risk of prosecution, that you have to provide financial information every quarter. Once again, every quarter is every 3 months. Now, of such heavy information that it could be a burden, it could be a big load. So there is a cost and benefit analysis of financial reporting. Another thing is the collection of and verifying of information is rather cumbersome, is rather difficult at sometimes. Changes in accounting systems and processes of information. So, for example, in July 1st, 2000, Australia introduced general sales tax July 1st of 2000. July 1st because Australia's accounting period usually starts in July 1st and ends in June 30th. Anyways, so changes in accounting system and accounting standards or accounting rules or these really all affect and add up the cost of preparing financial reports. Now, as I mentioned, it's probably even a negligible, if non-existent, cost for bigger firms. However, for smaller firms, smaller reporting entities, it could be a major burden. Additional annual report preparation costs. All right. So assets, equity definition. These are ideas that you should know, and it's expected that you know from previous uh, mandatory courses. All right. So I just blew my whole camera up by like 1,000%. Anyways, but hope you learned something. Hope you had a good review session with me going through a lot of the foundational and a lot of bedrock content that is needed for the course, for accounting, for going through business in general. So I hope you enjoyed or learned something from the course. Sorry if I keep looking up because right out. This is the view from what I am seeing. It's such a stunning view, and often people will be walking by, and I just have to check out and see if that's someone I know. If it is, that'll be really awkward because I'm in the process of recording. Anyways, thanks for coming along, and I'll see you guys next time for the courses that you might be taking or we might be taking in common, or for the weekly reviews for ACCT 1006. So thanks for coming along. Without further ado, take care, and I'll see you guys next time. Goodbye.